Welcome back in, everyone. I hope you're having a great day today. This week, two of my biggest holdings, Google and Meta, are both being attacked. Meta is being forced to pay $4.2 million in compensation, and YouTube must pay $1.8 million. YouTube is Google in compensation, as they've been sued by a 20-year-old. And the judge has come to the conclusion that both of their products are addictive and harmful to children and any underage users on the platform. This caused a very big sell-off in Meta share price. Meta fell close to $500 per share. I believe it fell to around in the 520, 530 range. The company came into the year close to $700, so definitely seen a big dip in Meta this year. Google took a short-term hit. They didn't see as much of a hit as Meta did, as Google has, Google search business. This was just YouTube, which is only a fraction of Google's whole business. Nonetheless, big hit to Meta. This is also concerning as a Google shareholder. This is what's going to happen. Meta, they connect 3.5 roughly billion people on one of their platforms every single day across the world. They're obviously going to have, some hiccups here and there. Nothing you want to see. You want them to, get over things like this, work their way. They have plenty of things, plenty of restrictions, tons of different rules and regulations in place on their platforms that, protect their users, inform their users well as protect their personal data. With that being said, this is going to continue to get better in the future. I believe Meta is obviously a forever evolving company. They have been since the birth of the company. And they're going to power forward over the long term. Like I said, you can't have a city of 3.5, 4 billion users and have something slip past, the authorities. It's going to happen. Things happen in any town, any county, any state, any country. Things happen, things get passed, things are done wrongly. As long as Meta continues to, take accountability and push towards, protecting their users more and more over time, they'll be just fine. It's still a company with a very, very wide moat, probably the biggest and strongest network effect that this world has ever seen. As I keep reinstating, they have roughly 3.5 billion daily active users on one of their platforms. So obviously, and they're not even allowed in China or Russia. So for every other country in the world, they are the form of communication for the whole world. It's not just by age group. A lot of people say it's only for the boomers, it's only for kids. It's none of that. Instagram, Facebook, and WhatsApp are and Threads are four very dominant platforms. They will continue to dominate. They'll continue to connect the world for news, entertainment, communication, so on and so forth. And they'll continue to provide value for those users as well as for advertisers on the platform. So I think the company's in a great position. Meta has rebounded. I'm a little late to the video. I had a busy week, but you can see here on the year to date, they had this big dip. On here it shows it fell to 525 and 75 cents. Big dip here from $600 is basically what it was before the headline came out. We've almost rebounded all the way back up, but it is still a discount. I'm very glad to buy this company under $700 per share. We're now getting it under $600 per share. I didn't get to buy any down here at $525. Needless to say, the company is way undervalued. It's at 19 forward price to earnings for one of the widest moat companies in the world, one of the fastest growing companies in the world. As you can see, the revenues are just, for the size of this company, this is very, very fast. I believe this is the second fastest in the Mag 7. Correct me if I'm wrong. I know it's close if it's not second in terms of the last 1 year. 22% growth. Over the past decade, it's grown at 27% per year. The company is expected to grow, I believe, 30% year over year in the next quarter. And for the full year of 2026, I believe it's somewhere in the mid-20s for this year's revenue growth. So the company is definitely accelerating. They're one of the very few companies in the world that's already seeing positive returns on capital for their artificial intelligence investments. This is coming through their enhanced and targeted advertisements, allowing their average revenue per user, as they have that here as a KPI. As you can see here, this is skyrocketing. I mean, really, over the past 2 years, it's up 28% per year, their average revenue per user, while at the same time, you're seeing users go up over the past 2 years. The amount of users on their platforms has gone up 6% per year, which is fantastic considering they scale almost the entire world already. 3.6 billion people are using one of their platforms every single day, roughly. Quick projections. This is very, very bearish, I believe, for Meta here, but from $580 here today, if we see earnings per share growth decelerate over the past decade or so, this has been well above 20%. If this takes a big step back down to 15% earnings per share growth per year for the next 5 years, and the EPS multiple trades down to a 22, which is roughly in line with the S&P 500, which makes it like an average company This one has traded higher in the past. It's traded upwards into the mid higher 30s. It's also traded a little lower in 2022. It traded down to around 10 price to earnings. I don't think that's very normal for this company. That was obviously a amazing buying opportunity. But given these very, very reasonable assumptions here, we're getting 15 and a half, 16% returns per year for Meta. Right now, you can buy shares under $600, and 5 years out, you'll be able to double your money. So that's very, very impressive here. For 15% compound annual growth rate, you basically need to buy this one under $600, which is what I'm going to continue doing. I think some more realistic numbers for Meta is probably a 22-ish. We'll say 20. I believe they'll beat 20, but I believe 20% earnings per share growth every year for the next 5 years is very doable, and I think they'll trade closer to a 25 to a 30 price to earnings. We'll keep it at 25. That being said, if they do hit these marks, you're getting a 24% compound annual growth rate per year. Shares are under $600 now, and 3 years from now, they'll be at about $1.7 thousand. So that's roughly a triple in 3 years. Definitely a company I'm still interested in. I'm not too worried about the lawsuit, even though the market sold it off really bad. I wish I bought shares on the day that it fell to $5.25. That would have been a great opportunity. But let's take a look at Google too. It didn't get near the sell-off that Meta did, but a lot of people are talking about it. The company has sold off. It was around $350 at its all-time high earlier this year. I believe it was in the 340s. It's now fell down to under $300. This is a company I was buying last year at 150, 160, 170, 180. I've bought it for the past 3 years, actually. My share price is roughly around 170 over that time. I have sold some shares, so now my price is up to about 185. But that being said, I do think the company is still a very, very reasonable buy here today. This company has grown earnings per share per year over the past decade, well above 20%. Let's kick this back. Let's say we only get 16% earnings per share growth, and we traded at a 25 multiple, which is very reasonable for this company. It has so many things going for it. It's a monopoly in search. It has YouTube. It has other bets like Waymo. It has Google Cloud, which is exploding. The operating margins and the revenue for that business is exploding, as well as the other two players, Azure and AWS. That being said, let's say we get this 16% earnings per share growth, and let's say we trade down to a 22. This isn't great returns, but for a company that is this wide of a moat, this fast growth, they're going to beat 16% in my eyes over the next 5 years. You're still getting 10%. This is 10%. This is roughly in line with what you're going to get from an index long term. This could even beat the index over the next 5 years. I think we're more likely to see 22, we'll say 20%, and we traded at 25 price to earnings. And you're beating the market easily here, 16% returns. Shares are $300 now today, roughly. And 5 years from now, shares will be above $600 if these projections hit. I think Google's still a good buy. Just in general, the market has been selling off a lot this year, especially anything tech, anything high beta, anything that has to do with the AI CapEx build out, even companies in the chip space. As you can see, Nvidia is down roughly 7% this year. Basically anything that has to do with AI or anything that's tech that's not super defensive has been sold off. It hasn't got much of a bid this year. Just here, this is the S&P 500. This is the biggest companies in the world. You can see Nvidia down 7%, Apple down 6%, Microsoft has been crushed, down 21%, Amazon's down 7%, Google's down almost 7%, Broadcom's down almost 10%, Meta down over 10%, and this one was hit hard before the year, so this one's down a lot. Tesla's down 14%. Even Berkshire Hathaway, I believe this is more of a defensive company. This one's not getting a bid this year. It's down 4% this year. A lot of the banks have been crushed this year. JP Morgan down 9%. Eli Lilly down 14%. Johnson & Johnson, weirdly enough, up 19%. And then you have your defensive Walmart up 10%. Netflix, this one was crushed right at the start of the year. So this is a little weird, but it is up 6%. It's seen as a defensive. You have the oil companies. Exxon's up 35% thanks to the whole situation with Iran, the rising oil prices. Chevron's up 30%. MasterCard, very fast growing company, tech company, down 12% this year. Costco, very defensive, very similar to Walmart, up 16%. So you can see the rotation. And I think some of these opportunities, it's nothing crazy. This isn't 2008. But this is probably the best time I've seen to buy stocks in my 5-ish year investing journey. 2022 was a great opportunity. Last April was a great opportunity. I'm seeing companies today cheaper than both of those times. At least what I look at a lot of tech. I look at a lot of wide moat, high quality companies. I look at a company like MasterCard here. This is one of my biggest holdings. just look at the valuation compared to what it's been like over the past 10 years. And by the way, this company is accelerating growth. So you're getting one of the highest free cash flow yields you have gotten over the past decade. In fact, there's only been one time in the past 10 years that it's been cheaper than it is today. It's cheaper than it was in 2022. It's cheaper than it was in 2020 during the COVID crash when the worldwide economy shut down. The company that relies on payments it's much cheaper today than it was then. Only, like I said, only this one time in 2016 was it a little bit cheaper. And then you look at something like the revenue. The revenue is accelerating. Over the past 1 year, it's up 16% per year. Over the past 2 years, it's up 14%. The fastest rate you've seen here is basically this 5 year is really high because we did have this 2020, the COVID dip. But this is the fastest revenue growth we've seen from the company in its recent past, thanks to value-added services, as you can see here. They are growing at 23% over the past 1 year. Very impressive. Same thing with all the other metrics. You look at net income, it's accelerating. You look at free cash flow per share, it's accelerating. So nothing's wrong with the company. The moat isn't really being affected. I've went over in videos in the past. I'm not too worried about stable coins. In fact, they have their own stable coin system in place within the MasterCard ecosystem. I'm not too worried about the government-backed, payment rails. I've went over that in a video in the past, as well as I'm not too worried about regulatory pressures. They've MasterCard and Visa have both, handled with those in the past. They're not going to be able to flex pricing power like something like a FICO, which is now in trouble with the government, but they're going to be just fine. The world economy runs on MasterCard and Visa's payment rails. So this is a great opportunity. Like I said, this is a company that I followed almost the whole time. Once I really started getting into high quality, wide moat investing, I notified MasterCard as one of the widest moat companies in the world. And I just recently found the opportunity to really start buying in. I started buying shares under $550 in Q3, Q4 last year, and I've been adding this year as well. We'll take a look at Visa. This one's very similar case here for Visa. I slightly have a preference for for MasterCard over Visa because of the value-added services. It's a much bigger part of that company for MasterCard, and I believe it's going to protect their moat, their pricing power, a lot more from regulatory pressures, which is what I do think is the biggest threat to the company. But you're getting this very wide moat company at a 4% free cash flow yield. Same thing here. It's accelerating. The growth isn't as fast, but I do think this one might be, it's a little bigger, so it might be a little more defensible. Free cash flow per share accelerating. Everything else is accelerating here. Look at the dividends. This is one of those dividend growth companies that you just love to see. Shares outstanding are plummeting. Nothing's wrong with the company, but then if we go to the valuation here, free cash flow yield 10 years, it's almost as cheap as it's ever been. It was slightly cheaper here in 2022. This must have been to a slowdown in free cash flow. I don't remember this one dipping that much. That I could just be misremembering here, but it's roughly the cheapest it's been over the past decade. A great opportunity here for a very wide moat, very high quality company. Let's take a look at a couple other here that obviously we talked about Meta. I think that's an amazing opportunity. I think Amazon, this is a company that I don't follow too closely. It's very confusing for me. There's so many moving parts in this business and they just don't produce free cash flow. They just constantly reinvest. So it's very hard for me to value and follow this company along. But needless to say, we can look at this company on something like where's the valuations? Here we go. We'll look at it on price to earnings over the past 10 years. They obviously had negative earnings here, so we're not going to look at that. But you're getting it under a 30 price to earnings here. And the company, it's constant, like I said, constantly reinvesting back into growth, back into the business. And it's growing very fast. So you're historically paying a really high price to earnings here. Cheaper doesn't mean cheap, but I do believe for a company of this high quality, this size of a moat around this company, you really can't replace Amazon. You're getting it under a 30 price to earnings when it's historically traded around the 50s. And revenues are, over the past 1 year, up 12%. Over the past decade, it's up 20% per year. And then you look at something like the earnings per share, it's just skyrocketing up 30% over the past year. So I do think Amazon's a great buy. I think, like I said, I think a lot of these high quality tech names, some of the highest margin, widest moat, most important companies in the world, the world runs on Microsoft, Amazon, Google. All of these companies are just very fundamental to the whole world. We live in a tech world now, and they just run the world. Another great opportunity I see here is Adobe, another one of my biggest holdings. I see Adobe as basically the Excel of the creative sector, and this company it's priced for disruption, complete disruption now. As you can see here, the revenues have accelerated since the past quarter. Over the past 2 years, it's up 10.7%. Over the past 1 year, it's up basically 11%. and the company's trading at a 14 trailing price to earnings, 10.5 free cash flow yield, 8.5 after dilution. So the company is just so cheap. If the company is, as big as it is, as profitable as it is, without any growth for the next 10, 12 years, it will, without a doubt, be a positive investment. The math just adds up. You will receive more free cash flow per share than what you're paying initially for the company. Plus, you get whatever the business is worth after that. So Adobe's just set up to be a really great investment here. Let's look at some other metrics. You can see free cash flow per share is up 18% over the past 1 year. The reason this is much higher, as well as, let's look at the earnings per share. Here it is. Earnings per share is up 13%, much higher than revenue. That has a little bit to do with margins, but that mainly has to do with this right here. The buyback. Over the past 2 years, they bought back 5% of the company per year. They bought back 6.16% of the company over the past 12 months. Very impressive. I think they will continue to allocate even more and more capital into these buybacks, especially as the stock price just continues to get hammered, down 27% year to date, down 37% over the past 1 year, and down 51% over the past 5 years. This company has been hammered. If you went from the highs here, it's roughly down 70% from the 2021 highs. This is probably the most dislocated company in the market that I follow personally. So there's plenty of opportunities out there. There's even some companies like Copart. This isn't really a tech company. They do have tech aspects, but this company is such a wide moat company. They're a duopoly with a monopolistic market share within the scrap vehicle auctioning business. Very important sector, very important company for insurance companies. And just because they had a little dip here in revenues due to total loss claims, which happens, it's a little cyclical with insurance claims. The company's been hammered over the past year. It's down 42%. You're getting it at 21 price to earnings here. And the company has just been a great compounder over the past decade. It's grown revenues at 15% per share. You're getting a great balance sheet. Free cash flow per share. Over the past decade, it's up 26% per year. So one of the best compounders in the market. There's plenty of opportunities out there. Look past the war. This is all very short term. I keep preaching this. Now's a great time to buy stocks. Probably the best time I have seen in my 5 years of investing. And I think the last 2 days were a little better. The market's ran up here for 2 days straight. But still, needless to say, unless we shoot up another 10, 15, 20% in these tech names, I think there's so many great opportunities. Don't be sitting on the sideline now. Now's the time to be loading the boat on some of the best companies in the entire world. Let me know what you guys are buying down below. Make sure to drop a like and subscribe on your way out, and you'll have a great rest of your day.